Hey everyone, it's PJ Patterson here for Keystone Financial, and today is Monday, the 17th of February. I hope that you all had a wonderful Valentine's Day weekend. Friday, of course, last Friday the 14th was Valentine's Day. I took my lovely wife out to a nice Valentine's Day dinner, and today is our wedding anniversary, in fact, so we celebrate 13 years of marriage. And according to my wife, I'm not going to argue with this, but according to my wife, 13 of the best years of my life so far. So I'm not going to argue with that logic. Anyway, I hope you all had a great weekend. Let's get into the top three things today. I'm going to start off with how headlines and macro tourism kind of drive a narrative, and how I want you to be aware of it, but not get sucked into it. I'm going to talk a little bit about that. A bit of esoteric stuff today, but the second thing I'm going to tell you about is why it's important, again, that we have our insurances. I want to share with you a story about a client that caught me completely off guard on Friday. Pretty amazing stuff, and I just am going to use that as a platform to, I suppose, reinforce why we have our insurances. And then finally, I'm going to talk about how we use our full cycle investing process to actually front run markets. Very important concept to put into now this story that I continue to educate you on around full cycle investing using the quad model, and how that benefits us over the long term as investors. So first thing, let's talk about headlines. So on my screen right now, you can see I've got the CNBC website. And one of the things that I love is the way they will use a headline to discuss things that have already happened and try to explain why something did what it did. So that sounds a bit confusing, but let me tell you what I mean. So if you look at this headline here, gold posts weekly gain as virus fears lift safe haven demand. Now, that doesn't mean anything. And this is just a stupid assumption about why gold is going up. And it has absolutely nothing to do with the coronavirus. Not a damn thing to do with the virus. It has to do, rather, with, and I've been talking about this with you now for a number of weeks, it has to do with the fact that, first of all, gold's volatility is very low, and assets seek out uh, asset classes that have low volatility. Secondly, not inflation, excuse me, interest rates are down. So gold always does very well in a low and declining interest rate environment. And then, of course, there is this whole front running of marketing, and I'll talk about it in a little bit, where the market knows that because bond prices are going to continue to go down, it knows that gold's going to benefit. So those are the reasons why gold is posting weekly gains, not because of the coronavirus. The coronavirus is one of these things that comes along, and the media loves it. The mainstream financial press loves it, and they use it as all sorts of reasons to justify stuff. And here's another great example of this. This headline here, where Singapore downgrades 2020 economic forecast because amid the coronavirus outbreak. Well, here's the thing, right? That, and I've been talking about this as well, and you know this if you've been a regular viewer of these segments, is that the data, the global data around growth, for the most part, in many of the big economies of the world, so the U.S., China, the Asiatic region, Australia, and to a lesser degree in some emerging markets and other places, has been pretty bad. It's been pretty horrendous. So the reality is, again, the coronavirus will exacerbate that, but pardon me, it isn't the cause of these growth forecasts being downgraded. Those were already happening, and it's now just the authorities acknowledging that. So I always find it very fascinating, the stupid headlines that these places come up with to, justify or talk about why something is happening in the press. And my point of bringing this up is to say to you, as a client of my firm, to ignore 99% of the BS. In fact, ignore all of it. You really should actually ignore all of it. Every once in a while, there's one or two tidbits that are factual and accurate. But for the most part, it's sensational, it is reactionary, and it is actually wrong. So it's just, trying to get you or get eyeballs on their website, or potentially, I suppose, if it's the Wall Street Journal or something, sell newspapers. So Anyway, in large part, I think you should ignore all of that. Now, moving on to point number 2, I wanted to tell you a story, a fantastic story that happened to me on Friday evening. I got a request, a Facebook friend request from someone who was an old client of mine. He had moved with his family to Queensland back in, I don't know, 2010, 2011, something like that, and I kind of lost touch with them. They'd been a mortgage client, and then when I first started my financial planning business, I focused on selling insurances and making sure that people were insured. And I sold he and his wife a full suite of insurance products. And I just thought I'd share with you the message. Almost the moment that I accepted his friend request, I got a message on Messenger, and I couldn't believe what I was reading. So this is the message here, and he just says, "Hey PJ, I hope you're well. And I just wanted to say thanks for selling me the life, income protection, business continuity, and TPD insurances back in 2008, 2009. I had it in 2016. I had a catastrophic motorcycle accident, became a paraplegic. Your insistence on what I needed without me even knowing it has ensured my kids can stay in their schools and I have a home. Thank you from the bottom of my heart." Now, you can imagine on Valentine's Day, I'm about to go to dinner with my wife. This happened in the evening, and I get this message, and I am flabbergasted. I am stunned. And a range of emotions went through my mind and my heart. I was obviously, I felt for, I won't name him, but I felt for this client, and was saddened by this accident that he had, that he is now confined to a wheelchair. But so pleased that I did the right thing by the client and said, you need to have this stuff, and because you never know. And so I thought I would utilize this opportunity to say to all of you, and I know I have these conversations from time to time with many of you about the cost of insuring yourself for personal risk. So that'd be your life cover, your income protection, TPD, etc. And I have been very lucky that I have not had clients yet claiming on these policies. I think that I have entered the window in my business, and broadly with my client base, that I'm going to start to see the level of claim, incidence of claim increase, and that'll just be an effect of people are getting older, and most likely it'll be something like a critical illness or maybe a trauma claim. But I just want to reiterate for all of you that I sincerely hope that I write these insurances for you and that you never, ever have to use them. That is not why we take out insurance. But here's the thing. None of us know what's going to happen in our lives. And just as this client here had a motorcycle accident, probably went out that day for a ride with his mates, whatever, never thought that an accident would unfold. And I have yet to speak to this client. I've rung him, but I have yet to speak to him to get some more of the details around exactly what happened. But nevertheless, it just goes to show you that there are some things in life that you can't plan for. And that there's that old adage, right? You all know it, is that failing to plan is planning to fail. And all I can say is just thank goodness that this client had a number of insurances in place, because now his life, financially speaking, is covered. So I do hope that that when we have that, when you get your review for your insurance message every 6 months, we send one out automatically, that that you do maybe think about this individual or anyone else in your life that you know of who might have had financial hardship because they didn't have insurances, or doesn't have financial hardship because they have insurances. So please bear that in mind. And I think really the last thing I'll say about it is I think that having personal risk insurances for a period of your life is just a cost of doing business, and you just need to have them in place. It doesn't mean you'll have them forever, and hopefully, if I'm doing my job right, once you reach that peak earnings, peak debt, peak wealth accumulation, peak children as well, and you get sort of to the other side of that, one of the cool things is we can start scaling back insurances. So it isn't a commitment that you have for your entire life. So anyway, I just thought I'd share that story with you because it made me feel sad, but it made me feel really good that I knew that I had helped a client, and in their time of need, they got paid by the insurance company. So that was actually awesome. Now, final thing I wanted to talk about today is this concept of front-running markets and how we use the full cycle investing process to front-run markets. So one of the things you typically see me banging on about is earnings growth or lack thereof, and what that means for companies and the earnings cycle, because the earnings cycle is basically the business cycle, and it will drive stock markets to some degree. This is the latest print on earnings. So we've got 386 of the S&P companies reporting. And lo and behold, a number of the sectors that I own for clients, because the process has told me to that I should be investing in this stuff, are doing very well. And just a couple highlights, that would be utilities. Now, I did sell out of the utilities position recently, which I'm looking to buy it back a little bit cheaper, but hopefully that opportunity will come along. Just added consumer staples. So that is something that probably from here out will continue to ramp and look good. Earnings growth there is okay. It's positive, which is good. Utilities have just been killing it. Real estate, so REITs and real estate investment trusts, that is, have done very well in terms of earnings growth and so forth. Tech's actually done pretty well as well. I don't own any tech right now because there's a number of reasons I don't own tech. Tech is not a quad 4 holding, so that's why I'm not in tech. But I will look to, if we do get a really hardcore quad 4, the stock market corrects, the bond market's going to go ape shit, and it's a technical financial term for really doing really well. But anyway, we'll be able to buy back our info, or buy into the infotech and technology sectors, probably at a discount. So anyway, that is one of the signs and signals that we're doing the right thing. But I suppose more specifically, I want to talk about how we're front running the markets. So you've been hearing me talk about bond yields, and one of the interesting things that have occurred in bond yields and continue to occur in bond yields, here's a chart of the 10-year Treasury. It's one of the key terms that we look at, the 10-year. And as you can see, it has pretty much just gone and continue to go straight down. That's the yield. So the yield has gone down, which means bond prices have gone up, which means that all the bond holdings that I've got have gone up. So we've seen that happening. But one of the interesting things that happens in interest rate markets is, and it's a cause for concern, is when the short end of the curve, so the short-term rates, so in this case you have 3 month, 6 month, 12-month, 2-year, 5-year, 10-year. When the short end of the curve, which is the 3, 6, 12, 2-year, that's the short end of the curve. When it is more expensive at the short end of the curve than the long end, it is a signal that interest rates are going to be falling. And that is just well known in investing markets. It's well known in the bond markets, and it's a sign that people are more concerned about what's going to happen in the short term, and they know that the Fed's going to have to lower interest rates. So anyway, because they're bidding up the price or they're getting into shorter term securities. So anyway, the yield on the 3, 6, 12 month and 2-year are, well, first of all, the 2 and 5-year are at the same yield. The 12-month or 1-year is higher than the 2-year and 5-year, and of course the 6-month and 3-month are also higher than the well, pretty much all the other rates except for the 10-year. So all I'm really saying here is we've got some really interesting things that are developing in the interest rate market, and as such, again, this is why I'm positioned in treasuries in the U.S., because the Fed's going to have to cut interest rates. It's also why gold's volatility is so low, and it's actually the real reason why gold continues to go up. So this is a signal, and I've said it before, the bond market tells the Fed what the rate needs to be, not the other way around. People think it's the other way around. The Fed sets interest rate policy. Well, yes, they do, but where's the signal come from? It comes from the bond market. The bond market saying, hey, Fed, you're going to have to cut interest rates because we're looking at economic growth is bad, inflation is down and falling, and oh, there's your gold volatility. That's dropping, continues to drop precipitously. The commodity market, I think we've talked about. I don't have it here, but the commodity market, well, oil, natural gas, and oil are kind of a proxy for that. But the commodity markets are falling, which means the expectation for inflation will be much lower. Furthermore, the commodity markets are falling because the U.S. dollar, I just had a chart up of that, is just ramping higher. And in Quad 4, the U.S. dollar does really well. So interestingly, one of the positions that's done really well for a lot of my client accounts is simply the fact that I cashed out of Aussie dollars for a number of clients. I bought a bunch of USD somewhere around that 70 cent, 71 cent mark. That's been a really great trade. You just make money on the currency spread there. So the interesting thing about the process that I do is I get these signals from my friends at Hedgeye. I get these signals and all this market data that tells me how to invest your money and my money, because I invest the same way, and what asset classes to be positioned in for the highest probability of positive return. That's an important statement that I want you to just ponder for a second. I want to be positioned in the asset classes and sectors of the market that have the highest probability of positive return over the next 3 to 6 months sort of period. And I use this process, this quad model, to effectively tell me, do I stay with those positions, or are we now looking like we're going to transition out of that quad into another quad? What are the asset mixtures for the quad we're going into? And of course, we'll use market signals as well to confirm that that is what we should be doing. So I guess the final thing I'll say about this is I want to get the big stuff right, the big turns. I don't really care about the little squiggles. Well, maybe I bought it, maybe I bought it here instead of here, whatever. I don't really care necessarily about the little squiggles that occur in markets. What I care about is the long-term trend. So this trend, now this is a very short-term chart, but if you looked at a long-term chart of, that's the dollar rather, let me see if I got it on the 10-year. Now that's really a short-term chart too. So anyway, if you looked at a longer-term chart of the 10-year, you just see it from left to right. It's going down. Bond prices rising, interest rates falling. I want to get the big stuff right, because that's how you make money, is you stay on a trade like that for a long period of time. The skill that I'm honing now for my clients is trading in and out of those positions within a certain risk range. So in other words, if bond prices, for example, they drop off like this in that 10-year, but that might be a point to actually sell some of the bond position and wait till rates go back up to where I can buy back more of it. But trading really around a core position. Anyway, I'm not going to go too deeply into that. That is really all I've got to update you on this week. There's not a lot happening in markets. I think we're going to have to see a bit more economic data flowing through before markets start to get a bit spooked. They'll come up with some reason for it, though. It'll be coronavirus. It'll be some other stupid thing. But the reality is that it will be data-driven, which is what we are, and that's how I will continue to guide my investment decisions and the investment decisions that I put into play for you. So having said all of that, have a wonderful week. I hope that we don't get too much wet this week. I think we've had enough rain for a little while. So anyway, I will look forward to chatting to a number of you over the coming weeks. And if you have any questions about anything, please do let me know. And once again, have a wonderful